Hello, dividend growth stock investors, and happy Halloween. It is Colby, the DGI Crab, coming to you here on October 31st. And I thought that this would be a good time to discuss just kind of conceptually the idea behind the four major indexes. So, for those of you who aren't aware or aren't major stock market junkies like myself, you may hear in financial talks just these broad level discussions about the Dow Jones is up and the NASDAQ's down, and then what about the Russell and the S&P 500 and all this stuff. What is all this stuff, right? And how do you go about investing in these different things, and what exactly do they make up? So that would be interesting to take a look at a 4 ETF strategy where we would invest equally or maybe in weighted amounts into the four major indexes and kind of compare that to dividend investing or just doing like a total stock market sort of ETF and just see what might come out on top, advantages, disadvantages, and all of that good stuff in between. Now, if it's not obvious to you, I'm not a professional financial advisor. I am just simply a stock junkie who loves to research this stuff, and I have my own investing strategy that I love to share with you all here on YouTube. But don't take what I tell you as investment advice. Do your own due diligence. But what I'd like to do is just provide you with some different ideas and perspectives, and certainly like to open things up for discussion. So leave me a comment down below and let me know what you think of the four major indexes and if you're invested in any of the stuff that I'm going to go over here with you today. So the S&P 500, this is kind of the benchmark really of the overall health of the stock market. This is what a lot of people are going to invest in if they're a sort of a one fund type of investor. Voo and chill is kind of a common refrain that I see in the dividend growth community of like counter arguments to investing in dividends. You just buy the S&P 500. Which VOO is Vanguard's VOO. That's the one I personally invest in. SPY, which same as VOO, it's just the State Street version, basically. There's very, very minor differences between the two. That's stock ticker SPY, and it's the 500 largest publicly traded companies in the United States by market cap. And anyway, you're going to get it. You're going to get it weighted, right? So our top 10 holdings within the S&P 500 are your big boys. You've got your Apple, Microsoft, Nvidia. If you own one share of the S&P 500, 7.27% of it is made up of Apple stock, 6.57% is made up of Microsoft, etc. The S&P 500 is, again, I think this is just kind of the benchmark of the stock market, and if somebody is a one fund holding type of a person, this is typically the fund that they might have, if not a total stock market fund, which I'm going to talk about that a little bit later. All right, so then there's the NASDAQ. So the NASDAQ index, or the NASDAQ 100 index, is made up of more growth-oriented companies. You're going to get a lot of tech exposure with the NASDAQ. As you can see here, amongst the top 10 holdings, a lot of similarities to the S&P 500, right? Because the Magnificent Seven are all big tech companies. You've got Apple, Microsoft, Nvidia. Broadcom shot up way up on the list there. Meta, Amazon, Tesla, Costco, and Google. Now, QQQ is the largest ETF that tracks the 100 these 100 stocks in the NASDAQ 100 index. Now, there are some alternatives out there for a growth-oriented ETF like this that doesn't pay out a whole lot in dividends. I have a bit of a position in Schwab's SCHG, which has some similarities. It's got a lot of this NASDAQ stuff in it, but the NASDAQ actually excludes financials in this. So like you're not going to get any exposure to like MasterCard and Visa, for example. American Express, those types of companies in the NASDAQ. Again, it's a little bit more tech-oriented, very, very growth-heavy. Just a kind of a short, dirty explanation. And like I said, QQQ is the largest ETF in that particular space. Just like SPY, as of this recording, is still the largest ETF in terms of assets under management for the S&P 500. So then you come to the Dow Jones Industrial Average. So this one, I've always found this to be kind of an interesting ETF. It's not something that I invest in personally. But the Dow Jones Industrial Average ETF is designed, as it says here, to achieve an investment objective by holding a portfolio of the common stocks that are included in the Dow Jones Industrial Average. Dow Jones Industrial Average is about 30 stocks that are selected by bigwig financial types that are sort of meant to broadly encompass the overall United States economy. So it's a very small ETF. So you have your SPY that's got 500, maybe a little bit above 500 stocks in it as it gets rebalanced as new companies join and other companies fall off. Your NASDAQ 100, which obviously that's got 100 stocks in it. The Dow Jones Industrial Average only's got about 30. So, and again, the selection method is up to an individual group of folks that determine what goes in there. And I'm not particularly educated in the history of it, but there can be different stocks that join and different stocks that get kicked out as times change. So like, for example, Salesforce is in the Dow Jones Industrial Average. Obviously, Salesforce wouldn't have been in there years ago. It didn't even exist as a company. The largest company within it right now is United Health, just above 9% exposure. And you can see we've also got Microsoft in here, Goldman Sachs, Home Depot, Caterpillar. And what you'll notice here is we have some diversification here among the top 10 holdings of different industries. It's not so tech heavy. You've got your health insurance, healthcare space in United Health. You've got financials with Goldman Sachs, tech with Microsoft, some industrials with Caterpillar. So very, very interesting ETF. And as I'm going to show you here a little bit later, this one actually pays out monthly, which is another thing that's kind of intriguing about it, just personally. And then finally, you've got the Russell 2000. So the Russell 2000 is basically an index which measures the performance of small cap companies. So you're not going to have your larger S&P 500 companies in here. You're going to have a large basket, about 2,000 smaller companies that aren't within that group of top 500. So for overall diversification, if all you're doing is investing in the S&P 500, you're not going to have any exposure to these littler guys in here that may not necessarily be the household names that you're used to seeing, but have a lot of potential for big time growth, and also have a bit more risk in terms of they might fall off. They're not as well established as some of the big wigs in the S&P 500. So this is going to give you, again, extremely broad diversification. There are different ETFs that cover different ranges of this. You could get like a Russell 1000 index, or you could do an overall Russell 2000, and IWM is the largest ETF in terms of assets under management that tracks this particular index. So let's talk about the advantages and disadvantages of investing in these 4 ETFs. So let's just assume that you were a passive investor. You decided you wanted exposure to all of these, all the 4 major indexes, and you just said, you know what, I'm going to do just 25% into each of the 4, set it and forget it. What are the advantages and disadvantages of doing that? So the advantages are you're going to get broad diversification. So you get your S&P 500, you get your 5 big 100 companies, your 2,000 small ones with the Russell 2000, and then you're going to get some additional exposure to the Dow Jones companies and then to the NASDAQ 100 companies. So a lot of diversification overall. And maybe you don't want to do 25% into each. So if you were just investing in these 4, you could control how much you're investing in each individual sector or index. So maybe maybe you want to put more into the S&P 500 and less into the Dow Jones, or vice versa in a given week or month, and you want to try to time that in some sort of a way or another. I could see maybe wanting to do that a little bit if you see one index is doing really well, but the other one's kind of struggling at a given time when you go to invest. Maybe you would wait that out a little bit. And then with all of these, you're getting excellent historic share price appreciation. There's a right angle up 45 degrees with all of these, and it's not exactly uniform. Some do better than others on given years, but it's a very safe way to invest. Now, your disadvantages are going to be, for one, if you are concerned with dividend yield at all, your overall dividend yield and dividend growth amongst these four is not impressive. I've said before that the S&P 500 is the worst dividend-based investment that I make. It's a low starting yield. The overall dividend growth is some years better than others. It's certainly not as consistent as some of the more dividend-focused ETFs that I purchased, like on the Great Dividend ETF Race series. There's going to be very little exposure to REITs, real estate investment trusts, and there's going to be some REITs like in the S&P 500. There's some spattered around in the Russell 2000, but you're going to get very, very little real estate exposure overall. And if you're a younger investor, that's not necessarily a big deal, but the older you get, the more real estate you may want to have in your portfolio, again, to get dividend yield. You're also not getting any international stock exposure if you're just primarily investing in these four major indexes. So any of the great non-US companies that are out there, you'll get no exposure to those whatsoever if this is all that you're investing in. So I would think that perhaps a total stock market fund might be a simpler approach than just splitting it out over the four indexes. So the question is, what does that look like? Well, I leaned on ChatGPT a little bit on this, you guys, and what a great tool that is when you're doing research on stocks. Let me know if you've used ChatGPT when you're doing some of your research in your investments. But what I did was I asked it to get me the performance from 2010 to 2020, because that's all in the books for a while now. It could go look that up for me and let me know what the cumulative returns were. Well, from 2010 to 2020, the S&P 500 would have gotten you a 265% return, the Dow 195, the Russell 224, and the NASDAQ 435. Now, then you've got VTI, which is the Vanguard Total Stock Market Fund, which is going to just be a weighted ETF that is going to give you exposure to every stock that's contained within any of these four major indexes. What if you just had that one fund? Well, if you just did a totally equally balanced contribution between those four, let's go back here. Sorry about that. It's a totally equal combination between those four. Then your overall average return over those 10 years was going to be 282.5% versus just doing one fund, a total stock market fund at VTI would have gotten you a 290% return. So not a major difference, but still a little bit better overall, and it overall would have been a simpler portfolio to just do a total stock market fund and not worry about which of the indexes was doing better at any given point in time. And then finally, as a dividend-focused channel, I like to take a look at the dividend stats and just see what you could expect with an equally weighted investment into each of the four indexes. And what you're going to find here is it's not all that impressive. You're going to get a cumulative dividend yield of just a little above 1% and a 5-year growth rate in the high sixes. So not fantastic. Now you will, particularly with something like QQQ, get excellent share price appreciation, as we saw in the previous slide, where it was well above a 400% total return on the share price in the previous decade. But if you're looking for income from dividends, S&P 500 isn't great, and pairing it with the other three isn't going to get you a whole lot either. So I probably wouldn't personally, and I'm not invested into any of the three outside of the S&P 500, and I like to pick and choose my spots with both individual stocks and dividend-focused ETFs. That's where I land on it anyway. But again, if you just want to have, overall diversification and exposure to all of these major indexes, you certainly could do that by going with the four major players. Let me know what you think.